Today I will be discussing international trade, more importantly the foreign exchange market and what it consists of so it can remain a stable market economy. I will explain how interest rates, political stability, political instability, monetary policy, and wars affect on the foreign exchange and why it occurs. Foreign exchange market consists of individuals, firms, and banks that buy and sell foreign currencies or foreign exchange. The framework for the exchange of one national currency is sold for another. The market is compromised for any currency, of all locations where it is bought and sold for other currencies. These different monetary centers are in constant contact with one another due to being electronically connected 24 hours a day. This graph shows the effects of the prices of US goods which rise relative to the prices of German goods. The x-axis consists of quantity of items sold, and the y-axis is the exchange rate between euros and the American dollar. At euro per US dollar equilibrium, the exchange rate is higher with a smaller quantity US dollars in use. At US dollar per euro equilibrium, the exchange rate is smaller with less euros being spent. Americans will demand the less expensive German goods, but in order to purchase them they must convert to euros, making the demand for euros increase, leading to a shift to the right. In order to buy the euros, Americans will supply US dollars to the foreign exchange market, so the US dollar shift to the right. Foreign exchange market can sometimes be very beneficial to an economy. It consists of superior liquidity which will ensure price stability and better trade execution. It allows traders to easily open and close the transaction, making it difficult to extend the operation of the market. It is also a 24-hour market, which means there is constantly opportunities for purchases and sales, making it the biggest and easiest accessible market. It provides a much greater purchasing power than many other markets. It has a low transaction cost, allowing almost all brokers to offer commission-free trading. The forex market requires less capital start trading than any other market, making it a very profitable professional market. This graph illustrates some of the drawbacks of the foreign exchange market. The euro currency fluctuates from 2005 to 2010, which can cause stoppage of trading between countries because they can be spending way too much for a product. Currencies can also fluctuate if the economic conditions are poor, because trading with poor countries would not be beneficial for the purchaser. This market is also fast and volatile, which means you can make money fast but also lose money too. With it taking place on the internet, scammers can be present trying to lure you in and take your money. Within the foreign exchange market, there are two types of currency markets, one being spot market where goods, both perishable and non-perishable, are sold for cash and delivered immediately or within a 2-day time span. Purchases are settled in cash at the current prices set by the markets, opposed to price at time of delivery. An example of a spot commodity that is regularly sold is gold. It is sold at the current price, then physically delivered later. The second currency market is forward market or futures trading. Forward market has a purchaser who has the long position, whereas the seller of the contract has the short position. The short position holder delivers the commodity to the long position holder at the settlement date, which can be a week, year. The long position holder then profits when the price of the commodity increases, whereas the short position holder profits when the price of the commodity decreases. Once the buyer and seller agree on the deal, the clearinghouse will buy seller's contract, then sell it to the buyer. This is done to prevent money being lost between the two parties, just in case the seller cancels or fails to fulfill the contract. This graph shows the exchange rate of pounds per dollar, and an increase in the supply of a currency depress its price. This can result in an increase in imports relative to exports or speculative selling of the currency. At equilibrium, there is a specific rate where export revenue and import spending are equal. For instance, England in this case is increasing the supply of their currency, which will cause the currency to depreciate, which allows the US to buy more pounds for a cheaper price. Political stability is a large factor that allows the foreign exchange market to run smoothly between countries. Countries that maintain a stable economy make good customers because they have the money on hand and can be trusted. A country with positive attributes will draw investment funds away from other countries that are perceived to have more political and economical risks. War, on the other hand, will cause countries to stay away from making trades. Buyers don't want to deal with countries that are going through political turmoil because it can cause a loss of confidence in the currency, and a movement of capital will focus on countries with a more stable currency. War can cause damage to the infrastructure, which deals a huge blow to a nation's short-term economic viability. As well as rebuilding efforts must often be financed with cheap capital, lowering interest rates, which decreases the value of a domestic currency. When a country's currency appreciates, it becomes relatively less competitive with other countries when exporting their goods. This can really hurt them because the country's exports decrease, which causes a decrease in money flowing into the government. This also goes with tourism because less people would want to go to a country where it costs more to go due to a higher exchange rate. Countries that are in a recession will buy less imports because they don't have the money and demand for the products. This causes countries with low inflation rates to see an appreciation in the value of their currency. Due to the currency having a greater value, it would be hard for countries to get out of a recession because people wouldn't want to trade as much. Currency manipulation is when a country sells its own currency and buys up foreign reserves. A weaker currency cheapens the price of a country's exports, making them more attractive to international buyers by undercutting competitors. This can be a positive to a country because it can help their economy grow, as well as a negative, because growing too fast can cause world prices to rise, which could harm countries that are trying to get back on their feet financially. The foreign exchange market is greatly expanding and is becoming a dominant source of money making for many individuals. It is the most liquid financial market in the world. Traders include large banks, central banks, institutional investors, currency speculators, corporations, governments, other financial institutions, and retail investors. The average daily turnover in the global foreign exchange and related markets is continuously growing, making it one of the best markets in the world.